Hi, it's Mai here from the Self-Managed Super team at Vincent. In our last video, we discussed the difference between concessional and non-concessional contributions. So this week, we're going to cover off on the different types of contributions that you can make to super. So let's start by doing a quick recap on the difference between concessional and non-concessional, just because that will help tie into this, what we're discussing today. So concessional contributions are contributions for which somebody, either yourself, your employer, or a combination of the two, are claiming a tax deduction for. Whereas non-concessional contributions, you aren't claiming a tax deduction for. So now that we've covered off on that, let's go and look at employer contributions. So employer contributions are the amount that your employer pays directly into your super fund, and it's in addition to your take-home pay. Your employer is legally required to pay a percentage of your earnings, and your ordinary earnings to be more specific, into your super account if you are over the age of 18 and have earned more than $450 in the month. Now that percentage is currently set at 9.5% and is set to increase to 10% from 1 July 2021, provided the government doesn't change their mind on that. Now the amounts that your employer is legally required to pay to your super fund may also be known as super guarantee contributions or mandated super or mandated contributions. In addition to these contributions, your employer may also pay salary sacrifice contributions into your super fund. Salary sacrifice contributions are the amount of your normal salary or wages which you elect to forego or sacrifice, as the name suggests. And under these arrangements, you're reducing your taxable income and your take-home pay, as you're no longer receiving these amounts as wages or salary. Instead, these amounts are being paid directly to your super fund, who will pay tax at 15%. So this can be a great way to boost your super savings, and it's generally tax effective for those who are earning more than $37,000 per year. If you are self-employed, or you want the freedom and the flexibility to make extra contributions to your super when it suits you, you can also make what we call personal concessional contributions. So these are super contributions that you're claiming a tax deduction for in your tax return, and again are another great way to boost your super savings or gaining a benefit of a tax deduction that's reducing your taxable income. If you earn less than a certain threshold each year and you make after-tax super contributions, you may be eligible for a matching contribution from the government, which is called a super co-contribution, a government co-contribution. There's special eligibility criteria that you have to meet, and the government will automatically pay the co-contribution directly to your super fund if you do meet them. Now, downsizer contributions are a special one-off contribution that's available to people who are over the age of 65 and they have owned their home for more than 10 years and meet other eligibility criteria. So under the downsizer contribution rules, you may be able to contribute up to $300,000 from the sale of your home into your super fund. Now, the benefit of downsizer contributions is that they don't count to any contribution caps and they can still be made to your fund even if your total super balance is greater than the general transfer balance cap. Another contribution that you can make are called spouse contributions. So if your spouse earns a low or has no income, you may be able to claim a tax offset for any contributions you make on their behalf into their fund. In addition to this, you can potentially split your own concessional contributions with your spouse under what's called the contribution splitting rules. So that's the quick and hopefully somewhat simple explanation of some of the most common types of contributions that you can make into your super fund. Remember, there are annual caps that apply around making contributions to your fund and other rules, so remember to check with your tax accountant and financial advisor before you make any additional contributions. So remember, you can hit me with your general superannuation queries or SMSF specific ones by commenting on the comments here in LinkedIn or sending me a direct message. Thanks.